Hi Andrew.
Hi Rachel, how are you?
I'm well, and you?
No, I'm very well, very well.
Thanks so much.
Cold Melbourne.
Yes, it is absolutely freezing, isn't it? Both got blue hands.
Right.
So meeting with companies is clearly an important part of your investment process as a fund manager.
Yep.
Do you want to talk me through why that is and what you think you can find when you're in the room with someone as opposed to perhaps what's in the accounts or what they say they actually do?
Well, I guess as a fund manager, that's we're provided with the ability to go and see companies, which we find really, when you get to eyeball management, you can really sort of see what's going on in the business, and you get a feeling for how that business is going a lot better, and it's a lot easier to get the clarification on what the announcements say and those sort of things than just reading the announcement and having to try and interpret it yourself. So we find a lot of benefits. You also get to know management over time, and you get to see their body language, those sort of things, and be able to read how excited they are and how if they really truly believe in what they're saying. So
tell me, as part of the process, where do these meetings come in? Do you look through the accounts and, how does the process work before you actually get in and go and meet with the guys, or is it one of the first things you do?
I guess it's
girls, I should say.
Well, in terms of meeting companies, we really try and get out and see as many companies as possible, and you have to actually train yourself to see companies that might not screen too well, because quite often that's where the opportunity is. If everyone hates a company, then chances are that the price is too low. Well, not chances, maybe the price is too low, but that's where the opportunities come because no one else is looking at it. So you have to train yourself to think, what are other people not looking at? So we really try and see every company possible, but we'll get our ideas from many different avenues, if you like. So obviously looking at the results ourselves, speaking to other fund managers, also speaking to stockbrokers, watching the news, reading newspapers, doing everything we can to generate those ideas and see the companies. Okay,
and so what other aspects are vital when you're looking at, all right, so identifying high quality businesses at sort of, that are unappreciated, how difficult is that to do, and why do you go about doing that rather than just sort of jumping on the latest, high growth, great story?
Good companies see competition as great because they're probably winning market share from that competition. Companies that are struggling generally don't like the competition, and they'll give you every reason why that competition is not, it's not going to be able to sustain that heavy price discounting that they're doing. Or there's technology, they're winning customers off them, but their technology is not as great. So I wouldn't necessarily see that as the common element that management sees the competitor as good competition. Every competitor, I'm sure, would rather have less competitors themselves.
Yes, I suppose what I meant is more that they're complementary of things that perhaps another business is doing well, as opposed.
That's a good characteristic. We like companies that do that.
Yeah. So tell me, why were you in the US when you Ophir primarily invests in, Aussie small to mid caps? Is that correct? That's how you categorise your
there's multiple reasons why we were there. One, we went to Stephen Ng and my business partner and myself went to the Berkshire Hathaway AGM to hear Warren Buffett and Charlie Munger speak. But two, a lot of our companies, Australian companies, have significant operations offshore in the US. And you only get a true picture if you go and speak to them and speak to their competitors in the United States. If you try and do it from Australia and you're lazy and just read what's on your computer screen, you'll miss what's actually happening over there. So we really get over there to dot the I's and cross the T's of our investments that are doing well there at the moment.
And are a majority of companies pretty open to you doing that?
Yeah, they are. I think everyone loves, one, talking about their business, but two, they want to make sure that investors are informed at the level that they should be in terms of their company and make sure it doesn't slip through the cracks.
So it is a fairly new trend, you may or not agree with me, that Australian businesses are doing really well on a global stage, or actually making a significant amount of their money outside of Australia.
Yeah, no, 100% agree.
Yeah.
I'd say last 10 years has been a watershed, probably 5 years ago, where Australian companies started to go overseas and actually make money. Previously, it was a graveyard for capital. If you reallocated it offshore, we've seen lots of classic examples of top 100 Australian companies that burnt significant amounts of money offshore. Whereas now we're seeing many Australian companies go there and they're successful. Now, I'm sure you're going to ask me, why is that? And I've spent a lot of time thinking about it. I really have. And I think there's many reasons. One, you just think about Google and what social media, Google, the likes, all enable customers to do in these foreign jurisdictions. They can learn about a brand very quickly. And it means if you expand to the US or Europe, your customers can learn about you quite quickly, so you can disrupt the incumbent. It doesn't take hundreds of millions of dollars of marketing to get out there to get your brand there. Two, I think just technology is developing significantly, and so it's easier to disrupt the incumbent businesses that are in these jurisdictions by just doing something smarter or better, something that makes for the customer, decreases the time for the customer to carry out a task. Technology is allowing you to do that, and some Australian and New Zealand companies as well have really done this very well over the last 5 years.
And do you think that the flexibility or the ability for a small or medium-sized business to be more nimble also enables them to have perhaps earlier stage success offshore, which traditionally was biotech?
I'll give you a really interesting stat. 10 years ago, the 5 largest companies in the US were the likes of General Electric, Citigroup, Microsoft was in there, and ExxonMobil. They were big, old world companies. Mm-hmm. Now it is Facebook, Amazon, Google, Microsoft still. They're new world companies, and they're disrupting. These companies have come from really nothing, and they've been able to disrupt, and they're very nimble in terms of their management and how they're able to operate. And as Jeff Bezos says, your profit or your margin is my opportunity. And we see that what is the opportunity for Australian small caps to go internationally is also the threat from companies like Amazon to come to Australia. What we see with, Amazon coming to Australia is you've got Woolworths and Coles that operate on quite small margin, that have a significant lease expense. What happens to them when 5% of grocery goes online? Yeah. How do they cover that with this big fixed overhead paying those leases when their sales start to take a hit? That's a question. Now, you'd say, well, they need to reinvest and have their own online, but why have they got such high dividend yields? Because Australian investors want a high amount of payout. We see that as the risk to a lot of the Australian blue chips, that they're making a high amount of profit. They're now susceptible to disruption, and they also pay out a lot because of their investor base in dividends when they really need to reinvest into their business.
Where do you think we are on in terms of the education or the learning, or what can we be doing better in Australia to support those organisations that are incredibly sort of have a bit of a tough time on the market at the moment?
I think we really just need to take the time to understand these businesses and understand they're operating on a global scale. They're not operating servicing 24 million people in Australia. In some cases, they're servicing 6 billion, or in the case of A2 Milk, it's 1 billion people in China. What does that mean in terms of how much money they need to invest? So maybe at zero profits in the short to medium term. Yeah. But what's the opportunity longer term? And that's why Amazon has been so successful. It's reinvested the profits, but the returns it's been able to make as it's disrupted these old old world businesses have been huge. So it's just getting to learn the business and learning the opportunity, but also looking at the global businesses and comparing them and just say, are these of the same quality as some of these global businesses? And if so, should they trade on similar multiples or similar valuations?
How important is culture when you're assessing a business? Because that's another thing that I think perhaps can get watered down or diluted as a business shifts, and it can have a dramatic impact on performance, can't it? We see it with change of CEOs or CFOs, but even just by assessing Glassdoor and seeing what's going on internally in some businesses, is that important?
Yeah, it is. And one thing we try to do is we look for if a CFO has left the business or senior management has left the business, we'll try and speak to them, asking them that direct question in terms of culture and why was this company unable to keep hold of you, and make sure that culture is fine, because a high amount of turnover of staff in these businesses that are increasingly reliant on the people that are actually driving them. They are people businesses. High amount of turnover is very bad. So you can't have a toxic culture.
Yeah. So how do you imagine that the ASX and particularly the small and medium end of the market is going to look in terms of the next sort of 5 or 10 years? Do you think that tech's just going to continue transforming it? What else?
Yeah, I personally do. I think we're on a technology curve now, and technology is accelerating, and the ability to disrupt is accelerating. We've seen some really interesting data on the United States as a sort of, I guess, a view into the future of Australia, but what's also happening in Australia, I guess, is that the company lifespan that stays in terms of the S&P 500 is getting shorter and shorter. So in the 60s, you're in the S&P 500 for an average of 30 years, where it's down to 15 years now. So that's showing you,
really?
And it's forecasted to go lower and lower. So what that's showing you is that the company lifespan is getting shorter. That moat or the competitive advantage that companies are able to have, they can't maintain them for as long as they used to. Once upon a time, you'd be in the S&P 500, you'd stay in there forever. Now you go in there and you're more of a flash in the pan. So I think we're going to see some more businesses, ones that it might be 100 million market cap now, or maybe they exist in the garage of someone in Western Sydney. Yeah. We're going to see these businesses become fast successes, and we're going to see a lot more of the old world companies be disrupted by these new players, be them domestically or internationally, and we're going to see a lot of fallen angels as well as the rising stars come through. You've seen A2 Milk, and that's a play on the Chinese and their want for the Australian brand infant formula. That's the largest company in New Zealand now. That was a small company 3, 4, 5 years ago. Yep. So that shows you how fast businesses can scale. We haven't seen this in my lifetime. That hasn't been seen.
Well, you can see why you choose to specialise in that part of the market.
You get bang for your buck. Like,
yeah,
you pick a 10 bagger, and there's going to be more of them. They really make a difference to the portfolio. So it really pays to do your work.
Yeah. And what's your typical hold?
So in terms of period,
yeah.
It changes. So we've owned some companies since our inception, and then we have other ones that we will invest in, and after 6 months we will look at ourselves and say, hey, have we made a mistake here? There'll be a new bit of information and we'll sell. So as long as we're right, hopefully you can hold it for a longer period, but it changes from investment to investment.
Yeah.
If they're growing globally, right, you can own them for 10, 15, 20 years. Whereas in Australia, when it was 24 million people, there's only so many years you can keep growing before you sort of go X growth. So we're hoping that there's some companies that we own that we can own them. The ideal is to own them for 20 years, right? And then hopefully they're $50 billion companies.
Set and forget.
Yeah, exactly.
So talking about you've just mentioned that perhaps you question whether or not you got something wrong. What are generally the catalysts for that? Is it sort of, do you just have a...
Notice, you're looking at your screen and it says notice received, and you're like, we've got no idea why this company has just gone notice received, and it's a big earnings downgrade or something. That's the worst case scenario. But in truth, it's when we see that the story is changing. If management changes their strategy, that's generally a big sell signal. When the company goes ex-growth, that's a good thing. If you've invested in the business early and you can sort of see it's slowing, and we're happy to leave the last 10, 20% on the table and sell it to the next investor to squeeze the lemon, if you like. There's lots of different reasons. Hopefully they're not the notice received big earnings downgrade ones. Hopefully they're ones that we've done the work in the background and we can see that this company is going to have issues in the future, or it's slowing for natural reasons.
On that point though, I think you'd probably have to be a little more patient, wouldn't you, in the small end, because you've got businesses that are essentially still learning, aren't they? You know, they might have their listed a few years ago and they have their first ever downgrade, or realise that perhaps an investment somewhere is not right. So is that still an alarm bell for you, or is it time to go and meet with someone and question, you know, see whether or not something's changed from the last time you met with them?
There's a real skill in terms of working out, is this downgrade a structural issue or is it a cyclical or seasonal issue? Yep. Generally, downgrades come in threes. So if we see an earnings downgrade that is a complete surprise, we will tend to move to sell the company, because we shouldn't be surprised. We should have done our work and we should know how much this company should be making in a period. That's what we're paid to do, what our investors paid us to do, and we spend a lot of time over. So if something takes us by surprise, we'll generally sell. However, when companies are growing so fast, there's no linear stock that just goes straight up, and there's businesses like realestate.com and TPG and car sales, which grew for a very long period, but they've had little stumbles along their way, and it's important to notice those little stumbles. Is that just a little stumble versus is that a structural problem? And generally, if it's a very good business model and very good management, you can give them a little bit leeway. But if you're a little bit uncertain about the management and a little bit uncertain about the company and the quality of the company, then we will sell quite quickly and quite aggressively, because we should have done our work and not been caught by surprise.
So Andrew, do you want to tell me a little bit about what attracted you to funds management? Have you always been in it?
Well, I think my father was the real attraction, because he was an economist, and so I studied economics at university and spoke to people like my father and people when I left university about what the best industry is to be in. My dad wanted me to work in Commonwealth Treasury or the Reserve Bank. I went to work for Commonwealth Treasury when Peter Costello was Treasurer. But then after that, I realised there was a bigger world than Canberra, and that's when I moved into funds management. So it's an ability to sort of put that economics and those principles that you learn both in a microeconomics, sort of on the company basis, like how companies can be profitable, and also the macroeconomics, all the big picture stuff as well. I can put that to work, and it's a great job, and it's really, really interesting. I'm so lucky to have the job that I do.
What tools do you use outside of clearly meeting with your investors to communicate with them and ensure that you're on the same page? And
we try to meet. We give it the opportunity for all our investors to meet us a couple of times a year. We go around the major capital cities and invite all our investors and anyone on our mailing list to see us. We also put out monthly detailed reports in terms of what we did right, but also what we did wrong, because I think you can easily just sit there and put out when you have a bad month, put out at Friday at 5 o'clock in the afternoon, put out your monthly report. But we like to be upfront and honest with our investors and tell them, hey, yeah, we might have got this company right, but the reason why you're down this month is because we got this company and this company wrong. But why we got them wrong, and whether we've exited them, or why we think that the market's got it wrong. So really just hold the hand, if you like, of our investors, so that they feel they know what they own in terms of the fund, and they really sort of understand the people who are managing their money and the motivations behind them in terms of how they manage the money.
If I'm someone trying to wanting to jump into the market, particularly in the small and medium space, is there any tips that you'd provide?
Oh, interesting.
To me?
I think you need to invest in what you understand. Too often I have friends who tell me about a company that they're invested in, and I say, I don't understand it. I don't know how you're going to understand this company. Really focus on what you understand. And look for companies where management has continued. If you look back in history, they've set out a strategy, and you can watch just over time as you read the announcements after that, them just slowly knock off each sort of milestone in terms of meeting that strategy. Yep. You're also looking for management that under promise and over deliver, and I think those sort of management teams are ones that you can sleep and get your 8 hours sleep a night investing with.
Fantastic.
Brilliant.
Thanks so
Thank you.
much.
Thanks very much, Rachel. Cheers.